Hello and welcome to the Scan the Markets webinar with me, David Madden. Now, before we get going, I just want to ensure that everyone can hear me okay and see the screen okay. What you should be able to see is the FX pays a logo up the top left, and the risk warning down the bottom left. I just want to ensure that everyone can hear me okay and see me okay before we get going. Just after typing in the chat box there saying, can everyone see the screen and can everyone hear me okay? So if you just respond to that, that'll be great. I just want to ensure that everything is A-okay before we look to kick things off. So what you should be seeing at the top left is the FX pays a logo, and then on the bottom left, you should be seeing the risk warning. If you can just get people to type in the chat box saying you can hear me okay and see me okay. Excellent. Got a response there. It's always positive. It's always better to ask these questions at the very beginning in terms of make sure the sound and the visual is all set up and it's working rather than actually mid-webinar itself. So I just want to give it another minute or two before I look to actually kick things off with the actual webinar itself. Excellent. Thank you for those who've responded. If anybody else has just joined in the last few seconds, I just would like to get your feedback. Can you see the screen okay? And can you hear me okay? I just want to make sure everyone is on board before we look to get things going. Up there in the chat box saying, is the sound and the visual okay? If you just respond to that, that'll be great. As soon as I get people saying they can hear me okay and they can see the screen just fine, then I'll look to get things going. I'll look to kick things off now. Those of you who just joined in the last couple of seconds, my name is David Madden. I work as a market analyst for Equity Capital in London, and Equity Capital is a part of the overall equity group, which of course includes FX Pesa in Kenya. So before we get things going, I just want to point out that trading in margin products carries a high risk. You should also see on the next slide along is the trying to get things going now in terms of the once again, slide along. Once again, you see the FX pays a logo here, and also trading in margin products carries a high risk. So first things first, let's get into what's going on with the markets. Those of you who've not attended any of my webinars before, I'll just give you a quick breakdown of the structure of it. I'll cover a handful of the major markets, big indices, big currency pairs, big commodities. I'll talk about what's going on from a fundamental basis in terms of what news is driving the markets. And I'll also analyze the markets from a charting or a technical analysis base as well. And if there are any questions you have for me about the webinar, feel free to just stop me and say, "Oh, David, I don't understand that. Please explain that again, or go through it differently." I'm more than happy to go into more detailed answers, especially if you don't understand what I'm talking about. But also, if there are any markets that I haven't covered in the webinar that you want me to take a look at, feel free to just say, shout out, "Oh, take a look at silver," or "Take a look at the Dow," or whatever it is. So first and foremost, I'll take a look at euro dollar. For those of you, just want to point out, I'm looking at a 4-hour time frame here. And in terms of the various things I have on the screen, I have 3 moving averages here: the 20-period moving average, the 50-period moving average, and the 100-period moving average. And then looking down here, I have the MACD indicator, which is a measure of momentum, which is kind of essentially a measure: are the buyers in control, are the sellers in control? And then looking down here, we have the RSI, the relative strength index. And that essentially kind of almost like is a measure of how quickly a market is turning in a certain direction. I kind of compare it to like an elastic band, whether, if you're stretching an elastic band in a certain direction, at some point the elastic band just kind of gives and it snaps back. It's like that, but for whether it measures whether a market is overbought or oversold. So once again, it's a kind of measure of how quickly a market moves in a certain direction. And if it moves excessively in a certain direction, that could be an early warning sign that it might move excessively in the opposite direction. So looking at euro dollar, we've seen a lot of volatility in the past couple of sessions on euro dollar. Why was this? Well, we saw on Wednesday, we saw on Tuesday rather, that US CPI picked lower, but it came in above expectations. Inflation in the US, CPI in the US dropped to 8.3%, but economists were expecting it to decline to 8.1%. And the fact CPI came in higher than expected ramped up fears that the Federal Reserve are going to continue down the path of hiking interest rates at an aggressive pace. And obviously, we have the Fed industry decision next week. The markets are pricing in a very high probability of another 75 basis points rate hike from the Fed. Keep in mind, it hiked by 75 basis points in the previous 2 meetings, so this would be 3 in a row. So with that, what did we see? We saw a sharp rally in the US dollar, and in turn we saw a sharp move lower in euro dollar. Yesterday over in the US, we saw PPI. PPI declined, suggesting there's some bit of inflationary cooling, or inflationary pressure is being eased in the US. But it didn't really have a huge impact on the US dollar. We can see here, from last Friday and on Monday, we saw a lot of weakness in the US dollar, which brought euro dollar to this level here. Since then, in the past 48 hours, we've seen a sharp rally in the US dollar and turn a sharp move lower in euro dollar. We can see here that the market has been moving aggressively lower in the kind of short term. Even though it's rebounded a small bit, it's still holding below these 2 simple moving averages, the 50-period moving average and the 100-period moving average. And while it continues to hold below these 2 simple moving averages, it's likely the more medium-term downward trend will continue. A move lower from here, if we do see a break below the recent lows here, we could see it back down to 0.9930. And a break below that, could see it down towards 0.9882. If we break below that, we can then be looking at retesting the 20-year low that was set in early September. And of course, if you break below that, we could then be at new 20-year lows, and we could be looking down towards 0.98 or 0.97. Taking a look at the price action in the past, 12 to 24 hours, we can see euro dollar has managed to kind of hold around this area here. A bit of a base has been formed in around the kind of 0.9955 region, thereabouts. We've only rebounded a small bit, but we haven't moved any lower at the same time. And it's worth pointing out the lows that we set here in the past 12 to 24 hours are still comfortably above the low that was set here, which is still comfortably above these lows along here. So can't really ignore the fact that this very short-term trend here is higher, but the more longer-term trend of the past few days, or the past 10 days, is higher as well. If euro dollar can manage to hold above this zone here and this base here around 0.9950, that could be an early indication that the market is going to continue to rally from here. If you rise from here, where can we target? Well, I've been looking up towards one spot 0038, and then a break beyond that could take us up toward this point here around 101.53. I'd only look to become more convincingly optimistic on euro dollar if we were to clear this peak here, which is quite close to 102. And of course, if we break beyond that, we then be back up the levels last seen in mid-August. We then be in levels of a 1 month high or a 5-week high. Keeping with the topic of a strong US dollar, now let's take a look at what's going on with gold. Traditionally speaking, there's been a strong inverse relationship between gold and the US dollar. Gold is traded in US dollars. Whenever we see a strong US dollar, which we're seeing recently, we typically see weakness in gold, and it's precisely that translates into precisely what we're seeing here. Looking at the price action, it's moved aggressively lower. In fact, it's fallen back to a level last seen in April 2020. So we're back close to 2.5-year lows on gold, which really kind of highlights how bearish the recent downward move has been. What's driving this? Strong US dollar, and also what's been hanging over gold as well is the rise in bond yields. The US 10-year yield today hit 3.45%. Keep in mind, in June it hit 3.48%, which was the highest level in 11 months. So we're not 11 months, 11 years. So we're not the highs of the US 10-year yield today are not too far away from 11-year highs. So why are bond yields influencing gold? Well, if you roll back the clock about 2 years into the height of the pandemic, central banks had brought interest rates basically to zero. Therefore the deposits, cash on deposit, basically yielded you 0% as well. And on top of that, government bonds were either offering negative yields or very, very low yields. So it's not a surprise that we saw gold hit its all-time high in August, September 2020, when the US dollar was really weak. Bank deposits were basically zero, yields were basically zero or negative. So you had loads of money being plowed into gold. Now what have we seen in the last few weeks and months? We've seen a steady rise in interest rates by the Federal Reserve. We've had 4 rate hikes from the Federal Reserve in the past 6 months. More rate hikes are in the pipeline. So people are now thinking, if I want to hold an asset that's considered to be low risk, gold is my only option. I could have cash sitting in deposit at a bank account. I could have money tied up in I could have money tied up in government bonds. After all, the US government bond is yielding over 3.4%. Gold doesn't pay an interest repayment. Gold doesn't pay a dividend. So these are all factors that are hanging over gold. I know some people out there, you come along and say, I just trade gold, or I trade a limited number of markets, including gold. And some people out there will never trade foreign exchange, which is fine. If you trade gold, you must keep an eye on what's going on with the US dollar. If the US dollar is strong, that typically puts pressure on gold. If the US dollar is weak, that typically pushes gold higher. So the strong dollar, higher yields has been impacting gold. We've fallen to a lowest level in almost 2.5 years. Looking at the MACD indicator, which measures momentum, we can see momentum is firmly in negative territory, indicating that the bears, the sellers, are in control. While gold continues to hold below all 3 of these simple moving averages, it's likely the more medium-term downward trend will continue. Moving lower from here, we can head back down towards 1660, 1650, and the next really big level to watch out for below that will be 1600. Looking at the RSI, which is the relative strength index, and as I mentioned a minute ago, it's almost like an elastic band. It kind of almost like how can it stretch as a market pain in a certain direction. It's moved firmly into oversold territory. So this might be an early warning sign that the recent downward move in price has become overstretched, which could mean a rebound in price is in the offing. It might be the case, it might not be the case. But if we do snap back from here, where could we target? Well, I've been looking up towards 1680. Because 1680 thereabouts was the last big low here. We can see thereabouts 1680, thereabouts 1680. So I'm looking towards 1680 to the upside, and then beyond that, 1690, and then of course if you go beyond that again, up towards 1700. One of the big losers on the markets today has been the UT 100, the Nasdaq 100. I mentioned a minute ago how US bond yields across the board are rising, but in particular, US 10-year yield. If bond yields are rising, that's essentially the bond market's way, or bond traders' way of signaling that they expect more interest rate hikes on the horizon. And if bond yields are rising, like I said, that expects the markets are pricing in more rate hikes from the relative central bank. Now, typically speaking, when the perception is interest rates are going to go up, or when interest rates actually do go up, that typically puts pressure on stock markets. A couple of reasons. Firstly, companies that are comprised of the stock market index themselves, if their borrowing cost goes up, that ultimately squeezes profits. Also, if borrowing costs are rising, that squeezes consumer activity. If borrowing costs are rising, it also might prompt the business in question to reconsider its expansion plans. If borrowing costs are rising, and a company mightn't set up another factory, it might look to expand into a different market. Also, with the factor as well is the yields. Going back to the analogy you made about gold, saying that gold was sort of the only show in town when it comes to risk-free investments or low-risk investments in the summer of 2020, because people, a disproportionately large amount of money was in gold because government bonds were yielding up zero or negative yields. Cash and deposit was basically getting you zero, so a lot of money went into gold. Now people are asking themselves, okay, government bond yields are rising. US 10-year yield is paying over 3%. Maybe I should be having more of my money tied up in government bonds, or maybe more of my cash should be tied up in bank accounts, because interest rates and yields are rising, making therefore stocks less attractive. Also, what's going on is that the companies that make up the Nasdaq 100, the UT 100, their borrowing costs are going up because interest rates are going up, and the overall perception in the markets is true. Although you have some very extremely powerful and wealthy companies such as Apple, broadly speaking, the tech sector as a whole has relatively high levels of debt compared with, say, the banking sector or the retail sector or the mining sector. So in the era of higher interest rates, stock markets across the board suffer. Some stocks will suffer more than others, and this is why people are zoning in on the tech sector. So very briefly, a few hours ago, the UT 100, the Nasdaq 100 traded at a 2-month low, and of course, keep in mind where we come from. The Nasdaq 100 back in June fell to a 19-20-month low. It underwent a fairly large rally here, and we appear to be moving lower yet again. Now, the question is we ask themselves is this downward move here a continuation of the much longer-term bearish trend, or is it a case of the market's falling here because it's given back some of the ground that was set up here, and we're going to have another move higher? If you recently fallen to a 2-month low and bond yields are rising, like I said, the high of the US 10-year yield today wasn't too far away from the 11-year high that was set 2 months ago or 3 months ago. If we do continue to see yields rise higher and higher and higher, that could put more and more pressure on stocks across the board, but in particular the UT 100, the Nasdaq 100. Now look at the price action here. It's fallen to a 2-month low. It's well below all 3 simple moving averages. The RSI is at the lower end of the range, suggesting the price bias is to the downside. If we do see the UT 100 continue to hold below these 3 simple moving averages, it's likely the recent downward trend will continue. Moving lower from here, I'll be looking back down towards 11,724. I'm breaking below that. I'm looking down towards 11,450. Looking at the price action in the last few hours, we can see this candle here. We see the red body here, and we can see this line coming off of it. This line coming off of it is known as the wick, and the wick is quite long. And when you have a long wick, that can denote indecision, meaning traders don't know which way to turn. Sure, the market was driven down to a 2-month low, but it didn't last very long, and now the market's rebounded quite quickly. So it seems to be a bit of indecision. Now, indecision can just mean the market might trade sideways. It could mean the market might entirely turn around and go in the opposite direction, or it could mean the market resumes in the most recent, in this case, downward trend. It just means it's indecision. There are no guarantees that the market's going to do a massive rebound. But The very fact we briefly hit a 2-month low and then quickly bounced off of it tells me that the bears are in control, but they're not super confident. They're a bit confident, but not very confident. So if we were to see a rebound, a continuation on this rebound, where can we target? Well, I'll be looking up towards this peak here around 12,185, and then beyond that, I'm looking up toward this zone here around 12,318. And then, as you can see here, when we saw interest rate fears ramp up in the US on Tuesday, when we saw a sharp sell-off in euro dollar, that was reflected by the sharp move to the downside in the UT 100. So it's only really if you're going to get well back up above around, say, 12,800, 12,900, would then look to kind of resume to kind of have a more optimistic and positive view for the UT 100. Coming on now to the oil market. The oil market has been holding up reasonably well. Late last week, US oil market dropped to an 8-month low. It's been rallying all week since. Yesterday actually spiked, hit its highest level since early September. So talking about a 10-day high was posted yesterday. This was after the International Energy Agency, the IEA, lifted its demand forecast for the period between October and March. They basically boosted their demand prediction up to 700,000 barrels of oil per day, which was essentially double the previous forecast. Essentially, the IEA predict that there's going to be a big switch from gas to oil, and with that, over the next, say, 5 to 6 months, we're going to see a big increase in demand for oil. And with that, we saw a sharp move to the upside in WTI US oil. That was yesterday. Today, the overall sentiment in the markets has been a bit more bearish. Metals have fallen, stocks have fallen. Bond yields are rising, indicating the markets expect more large rate hikes on the horizon, and the oil market has been dragged lower. In fact, the oil market has managed to kind of hand back all of the gains it racked up yesterday following the IEA upgrade to demand. So that itself says a lot. So we saw, it was only a week ago, or less than a week ago, we saw oil fall to an 8-month low. We've already handed back a lot of gains in a 12, 24-hour period. It looks as if the market's turning lower again. We're below all 3 simple moving averages. The RSI is moving lower, indicating the price bias is to the downside. The MACD indicator shows that momentum was in positive territory. It's now in negative territory, implying the bears are in control, the sellers are in control. We hold below these 3 simple moving averages. It's like the near-term downward trend will continue. Moving on from here, I'll be looking down towards 83.08, and below that down towards 82.08. And if we go below that, I'll be looking down towards the 8-month low that was set last week, around 80.90. On the flip side, we can't really ignore the fact that the more medium-term trend for US oil is higher. The very short-term trend is lower, but the more medium-term trend is higher. If US oil can manage to hold above this zone here around 83.08, that could be an early warning sign that the more medium-term trend is still intact. If we do rally from here, where can we target? I'm looking towards 85.81, and then a break beyond that up towards 87.68. As I said before, if anybody has any questions about what I'm talking about, feel free to just ask away. Alternatively, if there are any markets that I haven't covered and you want me to take a look at, feel free to just type in the chat box. I just wrote there in the chat box saying any questions. So if anybody has any questions for me, feel free to just type away, and I'll take a look at it. Coming on now to the DE30, the DAX. So this is the German stock market, and first things first, if you take a broad look at the price action we've seen in the DAX, in mid-August it was trading at a fairly high level, and then up until early September underwent a huge sell-off. Since then, between early September and only a couple of days ago, we saw a sharp rally, and then we saw another move to the downside again. If you take a look at the price action of the UT 100, the Nasdaq 100, it's not too dissimilar. In mid-August, it was at a peak. Around the 5th or 7th of September, it had dropped considerably. It enjoyed a large rally up until Tuesday just gone, and now it's been moving sharply lower again. The reason why I'm comparing the two markets, the UT100 with the PE30, is because of Dow theory. One of the tenets of Dow theory is that the averages must confirm each other, which essentially means markets that are quite similar should, in theory, move in the same direction at the same time by roughly the same amount. So if you're trading one stock market and you have a view in one stock market, for example, if you think to yourself, UT100 is going to trade lower, it's worth your while having a look at what other stock markets around the world are doing. If they're also trending lower, or they appear that they're going to trend lower, then you can be more confident that the UT100 will trend lower, because not always, but broadly speaking, stock markets or markets that are quite similar will move in the same direction at the same time. Stock markets around the world, we often see the cycle. You have a sell-off on Wall Street at night. The overnight session in Asia is bad. The continue-on session in Europe is bad again. That spills over to the US again, and the cycle continues. Or conversely, good news often kind of does a 24-hour cycle as well. So, some people out there will be like, "Oh, I trade, say, the FTSE, or I trade the S&P 500, or I trade the DAX, the Dow, and I don't trade anything else." Fair enough. You don't have to trade every single market. In fact, if you trade only a handful of markets, you can probably hone your skills better that way. But it's really important to be looking at the big picture view. If you're trading any stock market, be it the Nasdaq 100 or the Nikkei 225 or the DAX or whatever it is, it really is worth your while keeping an eye on what's going on with other stock markets, because they're all intertwined. And if you're looking at a market that's moving in a very different direction to other stock markets, that could be a sign that the market you're trading happens to be, I'm not saying wrong, but doing its own thing. And markets don't typically do their own thing for a prolonged period. They typically move in unison with each other. So the price action of the UT100 and the price action of the DE30 are reasonably similar. Which tells me that the two broad themes of the two are the same. Looking at the recent price action, the DE30, it's moved aggressively lower in the past couple of sessions. It's found a bit of a base so far. It's recovered a little bit. It's holding below rather these two simple moving averages. And while it continues to hold below these two simple moving averages, it's like a short-term downward trend will continue. Looking at the RSI, we can see it's moving lower. It moved aggressively lower here, and then it's been moving lower here at a less steep gradient. So the fact that RSI is moving lower suggests to me the price bias is still to the downside. If you do see any further losses from here, where can we target? Well, I'm looking down towards 12,888, and a break below that, I'm looking down towards 12,796. Now, looking at the MACD indicator, we can see momentum is firmly in negative territory, but we've seen a fairly sharp decline in negative momentum. So the bears are in control, but it seems to me that they're no longer as influential as they once were. So it's almost that we are seeing the bears influence the markets, hence why we see the market move lower. But it's almost like the selling pressure has waned. It's cooled a little bit. And that could be, that might simply be the pressure has waned for now, but it might ramp up in the next hour or tomorrow. Or it could be a case of selling pressure is waning now. It might decline further tomorrow, and we could see a rally by tomorrow afternoon. This is the sort of thing that I'm thinking about when I see a shift in momentum like this. Also, it's worth pointing out, we have rebounded from the recent lows. And I said a second ago about the long wicks from the candles. Look at these two candles here. Both of them are fairly long wicks. These two lines, they kind of stick out from the red bodies. Long wick can denote indecision. There's no guarantees that indecision will mean the market will just turn around, but it could be a case of the market trying to find its feet where it doesn't really have a clear direction. And in that space where the market doesn't have a clear direction, that could be a space where bargain hunters step in and buy up the market, or short covering takes place. So if we do see a rally in the DE30 from here, where can we target? Well, I'm looking up towards this zone here, this peak here, at 13,111, and then beyond that, I'll be looking up towards up towards 13,200, in around 13,196. Are there any markets you want me to take a look at? Because I'm just being conscious of the fact I've now been talking for about a half an hour non-stop, and it's been quite quiet on your front. So, is there any markets you want me to take a look at? Feel free to get in touch. Just put there in the chat box any markets you want me to take a look at. Feel free to just type away in the chat box. Dollar yen, sure thing coming up. So the first thing I want to talk about dollar yen is the first thing I do whenever first thing I observe in this chart is look at the price action. It's in a strong upward trend. I know from by following dollar yen, the peak that it set here was a 24-year high. So when a market hits the 24-year high, it really kind of sums up how bullish and how strong the market is. Although dollar yen has yet to actually retest the recent 24-year high, look at the price action. It's pulled back, it's rallied. It's pulled back, it's rallied. It's still holding above all three simple moving averages. The lows that we set here, let's draw this in around this zone here. These lows that were set here are comfortably above the lows that were set here. So we're still, we had a pullback, very large pullback. You didn't retest this zone here. It seems to be as if the kind of the broad, strong upward trend is still in effect. Yeah, sure, we haven't retested this peak and this peak. Close, didn't actually retest this peak here. It seems to me the broad, while we continue to hold above all three simple moving averages, broad bullish trend will continue. It's likely to continue rather. Going higher from here, I'm looking towards 144, 145, and then if we clear this peak here, just north of 145, we'll then be creating a new 24-year high, and of course, if it hit a 24-year high, in itself will be quite a bullish statement. And beyond that, looking towards 146, 147, 150 will be the next kind of really big level to watch out for to the upside on euro dollar. Looking at the MACD indicator, momentum is in negative territory, although negative momentum itself is in decline. So the bears are in control for now, but they're not overly influential. Looking at the RSI, it's off its recent peak. It's sort of in the middle of the range, kind of meandering along in no clear direction, and it's in the middle of the range. It suggests to me there's no strong price bias in either direction. So if we do see any moves to the downside in euro and dollar yen from here, I'm looking down toward this low here in around 140, 150, and then below that down towards 140 spot 30, and then of course 140 itself. Aussie, pound Aussie. Let's take a look at this now. Anything else outside of sterling Aussie? If there are no other markets you want me to look at after sterling Aussie, I'd like to wrap things up. So feel free to just type away in the chat box any markets you want me to cover. I already covered the Nasdaq earlier on, but I take a brief look at it again. So first reaction from sterling Aussie, we can see here that it's in a strong downward trend. And looking here at the very long term, we can see sterling Aussie recently fell back to a level last seen in 2017. So we're talking about a 4 or 5 year low in sterling Aussie. So the fact that sterling Aussie is at a 4 or 5 year low since 2017, that really suggests to me how bearish the market is. Fair enough, we're off. That was the low that was set here in late August. I know we recouped some of the ground, but still, only about a month ago we hit a 4 or 5 year low. That really suggests to me how bearish the big picture trend is still bearish. That being said, the more medium term trend here is clearly higher. If you look at this price action recently, it's clearly moving higher. The highs that we saw here only in the last 24 hours are back up to levels last seen about 3 weeks ago, 4 weeks ago even. So in the very kind of short term, while sterling Aussie in the kind of medium term, while it continues to hold above these 3 simple moving averages, it's likely the medium term upward trend will continue. A rally from here could see it retest the recent peak at 1.7210. Yes, 1.7210. Beyond that, I'll be looking up towards 173, and then beyond that again up towards 174.40, thereabouts. Can't ignore the fact that only a few weeks ago it hit a 4 or 5 year low. So the really big picture trend for sterling Aussie is lower. We just zoom out here, we get an idea. You know, in the last few weeks and months, we have been times where sterling Aussie has seen a large rebound only to roll over itself. So we saw a sharp rally here, only for the market to move aggressively lower here. We saw a sharp rally here, only for the market to move aggressively lower here and go on to hit a new multi-year low. You know, we've seen a fairly decent rally here. The market, on one hand though, the rally that we saw here was pretty strong, you know, but when it pulled back, the lows that we saw here were above this low, and now we're rallying again. So could this be the beginning of an upward trend? And an upward trend is defined as a higher high, a series of higher highs and higher lows. We've had the higher high, we've had the higher low, we've had the higher high, we've had the higher low. Could the market be turning around? But, you know, like I said, the longer term trend is to the downside. Moving lower from here, I've been looking back down towards, 170 itself, and down towards 1.6940, and below that down towards this area here around 169.80, and then below that down towards the recent, the low of 168.86. And then if we go below that, 168 will be the next big level to watch out for. Once again, I'll quickly run through the Nasdaq 100 once again. I covered it earlier on, and then I'll look to wrap things up. So the Nasdaq 100, the more medium-term trend, the longer-term trend for the market's lower, the very short-term trend for the market's lower. A few hours ago, it hit a 2-month low, so that really kind of suggests how bearish the market is if it's hitting a 2-month low. Looking at the RSI, we can see it appears to be rolling over once again, indicating the price bias is to the downside. While the UT100 continues to hold below these 3 simple moving averages, it's likely the recent downward trend will continue. Moving lower from here, I'll be looking towards 11,724, and below that down towards 11,450. And then of course, if you're below that, I'm looking down towards all of these lows here. And then of course, the big one to watch out for will be the low in the low that was posted in June, which was around 11, just south of 11,100. And the low that was posted in June was either a 19-month low or a 20-month low. So that was a big deal. And of course, if we break below that, then that would be a really big deal, because we'd then be talking about a 22-month low or even a 24-month low. Now looking at the other side of the coin, if you do see a snapback in the UT100 from here, where can we target? Well, I've been looking toward this peak here around 12,185. And then beyond that, I'm looking up toward this zone here around 12,318. I'll look to, as there are no more questions, I'll look to wrap things up there. So for everybody who stayed on to the very end, I want to thank you for your time. I appreciate it. I appreciate the patience as well, hanging on. For all of those who asked a few questions and threw in a few comments, much appreciated. It's always a bit more interesting for me when I have a bit of back and forth, and it's not just me talking at a camera. So I want to wish everyone have a good evening, have a good weekend, and I'll talk to you next week. That's all for me. Thank you very much. There in the chat box. Bye, everyone. Have a good evening, and you are more than welcome. Have a good evening, everyone. Thank you very much.